Welcome to Morningstar. Today I talk to Elbie Louw, Senior Manager Research Analyst at Morningstar, about India and specifically India's inclusion in a very important benchmark because from 28th of June this year, India is included in the popular and widely used emerging market local currency debt index, and that is the JPM-GBI-EM Global Diversified. The inclusion is phased in with India's stake increased by 1% each month until it reaches its maximum permitted weight of 10%, and that will be by April 2025. India's stake will then be in line with that of China, Indonesia, and Mexico. To allow for the inclusion of India, other markets will see their benchmark weights decrease, and that will include Thailand, South Africa, and Poland being affected the most. So, Elbie, what makes India attractive to be included in this index?
Well, thank you, Robert. From a macro perspective, India has a large population and strong economic growth. As of June 2024, the year-on-year GDP for India stood at 6.7%, for example, compared to China's 4.7%. Secondly, the India local market is also one of the largest debt markets, and it also boasts high liquidity.
And why does this happen now?
Well, the inclusion of India has been a bit of a debate for a number of years, but in recent years we've seen the exclusion of Russia as well as Egypt from the benchmark, and we've also seen a reduction in the weight of Turkey because of rising bond yields in that market and the depreciation of the currency. So we have a benchmark that is less diversified, and therefore investors were quite supportive of the inclusion of India into the benchmark.
And are there any challenges for managers in trading these bonds?
Well, that's quite an interesting point. From our conversations with managers, it does seem that trading the Indian local bond market is a bit of a different kettle of fish. That is related to the time it takes to open accounts as well as just the operational systems that should be able to accommodate this. For example, the custodianship. So when we spoke to BlackRock's local emerging market debt team early in 2024, they had done some operational checks as well as a few trades just to check that they are trade ready if and when they decide they want to lean into India's debt market.
And if we take it a step further, have you seen managers lean into India as it now is being included in the index?
Well, it's been interesting. Most of the hype seemed initially to be at the beginning when the benchmark changes was announced, with managers hoping to capitalize on that forced buying that was going to happen. And as we've spoken to managers since the inclusion, it seems that continues to persist as a tailwind for the market. But what we've also seen is that managers have not just blankly gone into India. They keep on looking at India's rates as well as the currency exposure from an investment perspective in relative to the rest of the investable universe. So they must balance their objectives of these strategies with metrics such as the level of tracking error that they are willing to tolerate, as well as any specific limits that they might have imposed on these strategies with regards to country over or underweights. And then we still continue to see managers being sensitive to those market technicals, such as the forced buying of ETFs towards the end of the month.
Okay. And can you give some examples of things that we have seen managers do?
Yes, so we're looking at the data as the months progress. So in July 2024, that was when the weight of India within the benchmark stood at 2%. One of the managers that we rate, the Colchester local markets bond strategy, had no exposure to the government bonds of India, while they had a small position, roughly 50 basis points, to the currency. But interestingly enough, this is not the only country that they didn't have any exposure to. They also didn't have any exposure to China or to Thai government bonds, because they felt that the relative real yields in those countries were not attractive versus the rest of the opportunity set. And they were also not comfortable with the financial stability score of China. Where we have seen them lean into and continue to do so is more in the Latin American countries such as Brazil and Mexico, where they feel that there are more attractive relative yields. June 2024, which is a bit earlier, the benchmark exposure was only at 1%. And interestingly enough, even at that stage, they already had a slight overweight position, holding 1.3% of Indian government bonds, compared to the benchmark's 1% at that stage. But what they did, which I thought was quite interesting, is to gain a little bit more exposure to the currency. They also held, amongst others, a position in a supranational bond that was issued in Indian rupee. So what we do see is that the inclusion of India continues to be a question of the objective of a fund, and relatively how that weighs up against the rest of the opportunity set that managers have at their disposal.
Okay, Elbie, thank you very much for your insights in the rise of India in this very important EMD index. Thank you all for watching. For Morningstar, I'm Robert van den Oever.